from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, travel is back and will continue to boom. This, according to Airbnb, out with an earnings beat that shows despite inflation and global macroeconomic uncertainty, people are on the move. We will break down their report. Plus, the leak heard across the country. A draft opinion of the Supreme Court reveals plans to overturn Roe versus Wade, hitting the U.S. like a bombshell. Some businesses are taking a stand. And how to use deep tech to tackle society's biggest problems. But can you solve climate change and still make a profit? More on that later this hour. All of that in a moment, but first we are watching Lyft and Airbnb, and another volatile day for stocks. Investors waiting for more clues about just what will happen if the Fed raises rates later this week as expected. Our Ed Ludlow here to break it all down. Ed.
Yeah, we swung between gains and losses on the NASDAQ 100 multiple times. Very tech-heavy index. Ultimately, closed up just 0.1%. But the other way to looking at it, it was the first back-to-back or two-day gain for the NASDAQ 100 since April 19th, so a couple of weeks. We're expecting a 50 basis point hike from the Fed on Wednesday, and we care. Why are we talking about the Fed and rate hikes in a tech show? Because tech stocks that are judged on their future growth, future profits, are more sensitive to higher interest rates because it discounts that rate of future profit. So we're all eyes glued on the Fed. It's been one of the main pieces of psychological driver for the market, at least around tech stocks. Also interesting to see Bitcoin drop below $38,000 per token on Tuesday, its lowest level since February, and it kind of caught up in this kind of treading water moment we're in right now ahead of that key Fed meeting. But we're in the depths of earnings season. As you say, two key companies for a read on the economy. The first, Lyft, down now 22% in after hours. Frankly, the number of riders that they reported were lower than expected, even if first quarter revenue beat analyst projections. They have 17.8 million active riders in the quarter, below what the street was looking for. Important to note, though, the CEO is saying that they expect demand to pick up in the second half of the year. A different story with Airbnb. Airbnb giving a revenue projection for the current quarter of $2.03 to $2.13 billion, well above street expectations. But there's fighting talk with the company saying that they're seeing substantial, quote, demand going into key summer months, Em.
All right, Ed Ludlow, thank you. I want to stick with Airbnb and Lyft now and bring in Brent Thill of Jefferies. Brent, great to have you back with us. Want to get your headline takeaway from Airbnb to start. I mean, substantial travel demand that Airbnb is seeing, despite the fact that we're in the middle of an ongoing war. In Europe, for example, we're facing global macroeconomic uncertainty and 40-year inflation. What's your takeaway from that?
Hey, Emily, we're tired of being inside doing Zooms. We all want to get out. And I think the travel pent-up demand from what we can see at Jefferies is like no other, which is we're shifting from, outfitting our home to outfitting our outdoors and our life. And the amount of travel cross-border, the return to cities, the actual return to European travel is all ramping significantly. And if you look at the number of trips that, we just survey that consumers are willing or wanting to take this summer, obviously, it's incredible. And so I think the cross-borders combined with return to cities is the biggest return and help for Airbnb. And I think ultimately we've also shifted, to quote Brian Chesky, their CEO. I mean, I really do believe this, and we don't like to parrot what CEOs say, but ultimately the world has changed in the sense of how we work, where we work, and how productive we can be. And I'm a firm believer that they're going to participate in that. So yeah, the big concern is as inflation hits and we have less dollars in our pocket because our mortgage rates are higher and our car payments are higher, does this pinch travel? I don't think it will in the short term because there's such pent up demand to go and be out. And right now, no one wants to sit and have a summer like we did last summer or the summer before. And
right.
That's only going to help them in the interim. And as business travel comes back too, in some sense, that will help the return to cities. And if you're going to, if I'm going to New York and I'm going to spend a week or 2 weeks with my team, I don't want to stay in a hotel. So I think that also is going to help with the return to the office in some sense, that it helps the enterprise business over time, which is obviously a smaller piece of the overall pie.
I think it's interesting, too, that travelers are booking further and further out. They're not doing this last minute, waiting to see what pandemic or COVID restrictions are. We're seeing the same thing potentially with Lyft, also beating estimates. What do you think this says about the health of the consumer? And I guess I wonder, is this a post-pandemic pop? And what happens later?
Yeah. I mean, everyone is in more Uber and Lyfts. I've been in more Uber and Lyfts in the last month than I was in the last 2 years combined. So just look at your own consumption personally and from a work perspective. I think the challenge with Lyft is their EBITDA guide for the next quarter is way below the street. The street was looking for 83 million. They guided 10 to 20, way below. So the stock's getting hammered on the increase in investments. And I think this is the challenge that we face in many of these reopening trades, is how much money are these companies willing to reinvest back in the business as they see demand come back, to get drivers, to get consumers back on the platform, to build the network out. And as they said during the pandemic, right, they brought the cost structure to the studs. There was no walls inside this house. It was studs. And they had that quote back in the middle of the pandemic. And I think, they've now right-sized, and now they're feeling dollars back. The big worry for investors on Lyft is just, can this business sustainably make money? And in my opinion, there's way better opening trades than Lyft, right? Uber is a global platform with multiple applications that they can benefit. It's a platform, not a point solution. Lyft is US only, rideshare in the US only, and they're really limited to the US market. So I think ultimately there's just better opening trades. So we at Jefferies like Booking, Airbnb, and I think Uber's in a better position among some of the other tech stocks we cover.
Lyft shares are way down after hours, Brent, 25%. Why do you think that is?
Well, that's, it goes back to the EBITDA guide. They're ramping up the expenses. And ultimately, to your point on inflation, look, we're all feeling it. It doesn't matter who you are. You're going to feel the pinch of what's happening with the broader economy starting to slow. So as that slows, are we going to see the air brakes come on, consumer spend? And I think there's a little bit of concern. I think the bigger concern really is around, is Lyft the best way to play the opening trade? Airbnb's up, Lyft stock's down. There's other stories that are better. And then you look at the EBITDA guide, it was obviously terrible relative to what the street wanted. And hopefully they're just being conservative now, obviously with the new CFO in place at Lyft.
All right, Brent Thill of Jefferies, always good to have your analysis here. Thank you so much, Brett. Do not miss our post-earnings conversation with Airbnb CEO Brian Chesky. That's coming up Wednesday right here on Bloomberg Technology. He just tweeted that the biggest change to Airbnb in a decade is coming. I'll ask him what that could be. Now, more of Elon Musk's vision for Twitter. Musk telling potential investors he could return Twitter to the public markets at a later date. This according to Dow Jones. Musk considering staging an IPO of Twitter in as little as 3 years. Twitter shares unchanged in late trading. We're going to have much more on that later this hour. Coming up, a seismic shock hits the U.S. Supreme Court. We're going to get the latest from Washington and how some companies are responding. That is next. This is Bloomberg.
This opinion is just off the wall. And I'm really shocked that Alito would have written it, assuming he did.
This is not some fluke. This is the result of a decades-long campaign by extremist Republicans to overturn Roe versus Wade.
I would be even more shocked if the other justices in the majority would decide on to this opinion.
This is the issue that can decide elections, at least as far as women are concerned.
There are people on both sides of this issue. And I think what we need to do as being good participants in a democracy is to listen to both sides.
This will be a galvanizing issue in the upcoming elections.
Reaction there after a leak of unprecedented proportions, a draft opinion from the Supreme Court. That draft, written by conservative Supreme Court Justice Samuel Alito and obtained by Politico, showed the justice overturning the 1973 ruling of Roe versus Wade. I'm joined now by our Washington correspondent, Anne-Marie Horton, for more on this extraordinary turn of events, for reaction from the White House. So, Anne-Marie, first of all, what do we know about this leak so far?
So there's really two parts to the story, Emily. First is the fact that this is an unprecedented leak, and you actually have a lot of Republicans all day pointing to the fact that this was a leak and this is going against really this institution that many believe should be guarded in terms of how they have their normal operating procedure. And then you have the Supreme Court come out and saying they're going to go after the leaker for this egregious act. Then, of course, you have the leak itself, the contents of that leak. And as you outlined there, what this leak does show is that the Supreme Court, as of February, this draft opinion would be overturning the 1973 Roe v. Wade and basically saying that a woman's right to an abortion, that constitutional right, they would be striking that down. And then this would be up to the states to decide. And as you can imagine, this has really set off fireworks in Washington, D.C.
Tell us more about what President Biden had to say in response to this today.
President Biden has made a number of comments today. First, a written statement, and then he also briefed reporters on his way to Alabama. So he's talking about the fact that this would go against basic fairness, given the fact that this is about a 50-year-old law. Take a listen to a little bit more about what he had to say, calling it a radical.
It goes far beyond, in my view, if it becomes a law and if what is written is what remains. It goes far beyond the concern of whether or not there is the right to choose. It goes to other basic rights.
Biden also pointed to the fact that he did get a phone call saying that this draft document was authentic, and the Supreme Court also said that. They said this draft document is real, but does not mean that that opinion will be upheld. So this is basically how we're going into potentially when we're going to get that opinion finalized and the unveiling of that in June. The president also, Emily, in his written statement clearly pointed to the fact that if this was to be overruled, that now it is up to elected officials and also voters in America in November to go to the polls. So now this has become a hot button election issue.
Hot button indeed. Bloomberg's Anne-Marie Horton. Thank you. I want to continue this conversation and talk about how companies are reacting to this news. I'm joined now by Laura Speakerman. She is the co-founder and chief revenue officer of Alloy, which has been rather proactive in offering reproductive benefits to employees. So Laura, you made the decision back in January to cover legal fees up to $5,000 if an employee or a partner faces legal issues due to anti-abortion laws. You're also giving them a travel stipend, medical cost stipend. Why did you decide to do this?
Yeah, that's right, Emily. This was important to us for a lot of reasons, but I think the two that I'll highlight today is that Alloy's mission, we're a fintech company. We really want to see equitable outcomes. Financial services industry plays a big role in that for people, particularly people of color, particularly women. And so supporting this really aligned very well with our values as a company and our mission and vision as a company. The second reason, potentially more tangible, is it supports our hiring and retention. We already have tons of policies and benefits in place, as do many companies, that help us attract and retain the best talent possible. And so this was an easy way to sort of say, look, this just adds on to our medical benefits, our PTO policies, all sorts of stuff. And so it was to us a necessary thing we had to do to remain competitive.
Now, you told Bloomberg News that reimbursing workers for abortion-related travel is the low bar of what they can do. What more should companies be doing?
Well, look, I think this is one piece of how to make life a little bit better for the poor, the people who have to go through this in their lives. It's not something anyone wants to have to deal with. It's just one piece of it. And so I think our policy will evolve as we decide how other potential benefits we could offer, or sort of evolving what reproductive rights means even for our population at Alloy. And I hope other companies would do the same. I think we're seeing that it's a really competitive talent industry. this is probably a low-ish bar and that it's a relatively inexpensive set of benefits related to, if you looked at what we spend on healthcare, for example, all sorts of stuff, incredibly expensive. And so I think there's a lot more there that we and other companies can do and probably have to do to fill in the gaps that the government has left us with.
Sheryl Sandberg of Meta posted today saying this is a scary day for women across our country. Every woman, no matter where she lives, must be free to choose whether and when she becomes a mother. Few things are more important to women's health and equality. And I just want to underscore that this is a draft opinion. It doesn't necessarily signal where the Supreme Court stands at this very moment. But we're seeing, a lot of criticism about how other companies are handling reproductive benefits. For example, Amazon came out with their package earlier this week. There's some criticism there that it doesn't cover contract workers, who are kind of the lifeblood of keeping the trains running on time at Amazon. Do you think their policy is lacking?
I haven't looked at that policy in detail. I would assume if it does not cover contract workers, that does seem like a big gap, considering that's a big part of their workforce. I think that's true of a lot of companies who are probably contemplating this. That being said, we haven't seen that many companies do this. I was really happy to see Yelp, Citibank, Amazon do this all in the last few days, really, I think. I would encourage Facebook, Meta, if that's how they feel about women, they should probably put something in place, offer really good benefits. We know they have a ton of money sitting around, ton of cash. This is a pretty easy thing for them to implement. And I would encourage any company that has the luxury of doing that to do it.
Now, Alloy has a history of taking a public stance on political issues. For example, you prohibit companies from using Alloy's products if they would deny customers access based on their immigration or citizenship status. Have you found taking these public political stands has hurt business at all?
No, we haven't. I can't promise you it never will, and we'll have to cross that bridge when we get there. We haven't. I think the benefits of what it has given, sort of the alignment between us, our values, and our team, again, in kind of keeping folks engaged, getting them on board, getting them excited about us and our mission, has outweighed any potential negative impacts we've seen so far. I don't think that there will be zero negative impacts. We work with a bunch of banks, which are historically much more conservative, as you can imagine. So I would anticipate some fallout at some point. For us, there's been basically no negative impacts thus far. And the moral imperative, as well as the business case I can make for this, really outweigh, to me, the risk that or make the risk very much worth it.
I'm curious what the internal reaction has been. Often companies don't want to take political stands because, it might impact their retention and recruiting efforts. Certainly, not necessarily everyone agrees with your policies, even people who work at your own company. What's been the reaction internally?
So far, really positive. Again, there may be people, I'm sure there are people who disagree with this who work at Alloy. And we are open to the idea that you don't have to agree with every single thing we do or everything I agree with or my co-founders agree with to be at Alloy. However, the response I've seen has been unilaterally positive. I've gotten a ton of messages and DMs from people, both when we announced the policy in January and today when we put out a statement, given the leak that happened last night. Just really positive feedback that this is something that aligns with their values and that they're proud to work here. I got a message today from someone in one of the states that I think is going to be the most impacted, who just said, they really appreciate it and it means a lot to them. So that was especially sort of heartening to hear.
All right. Laura Speakerman, co-founder of Ally, thanks for joining us today.
Thank you for having me.
Coming up, between supply constraints and COVID lockdowns, why Apple's third quarter forecast has analysts worried. That is next. This is Bloomberg.
Apple investors and Wall Street analysts were initially excited when Apple reported its second quarter earnings. The company said it generated $97 billion in revenue, with $50 billion of that coming from the iPhone and another $20 billion coming from a very strong services quarter. But the jubilation was short-lived. After announcing the results for Q2, Apple said that Q3 would be a challenge. Apple said it's expecting a $4 billion to $8 billion negative hit to revenue due to COVID-related lockdowns, the ongoing chip shortage, and global issues like the war in Ukraine. That means when Apple reports Q3 results in July, the overall revenue number will be up to $8 billion less than it could have been. This led to questions from analysts to CEO Tim Cook, such as, should the Apple supply chain be shifted to avoid these ongoing issues in China and the chip problems? Cook, of course, defended his infrastructure, but said that Apple's always looking at making tweaks. Analysts are still pegging a year-over-year revenue increase for the current quarter, a number around $84 billion. That, of course, remains fluid. Several Apple suppliers and assembly partners were temporarily closed in April amid China's ongoing crackdown on COVID cases. So far, that's led to some delays to high-end versions of the MacBook Pro and supply problems for the iPad. Apple's intense warning, however, indicates that consumers may just have a hard time finding other Apple products in the coming weeks and months, including the iPhone and Apple Watch. I'm Mark Gurman. This is Power On.
Don't forget, you can subscribe to Mark's weekly Power On newsletter at Bloomberg.com. And sticking with Apple, Bloomberg has learned the tech giant has hired someone who helped lead safety efforts and vehicle engineering at Ford. This is a sign that the iPhone maker is once again ramping up development of an electric car. Desi Wikashevich worked at Ford since 1991, most recently serving as its global director of automotive safety engineering. A bipartisan group of U.S. senators wants to loosen Google's grip on the digital ad market. Bloomberg has learned they plan to introduce legislation that would force Google to sell off parts of its lucrative ad tech business. The measure could also have implications for Amazon and Facebook parent Meta. And the SEC is beefing up its crypto enforcement team, the Wall Street regulator adding 20 staffers to its unit focused on policing crypto market abuses, from new coin offerings and crypto exchanges to DeFi platforms and NFTs. The office has brought more than 80 enforcement actions since launching in 2017. We'll have more on that in our crypto report later this hour. Coming up, one-click payment. My next guest says no such thing. I'll talk to the founder of Nate, a shopping app with a one-click checkout function, about that and the controversy surrounding its competitors. Next. Plus, we'll have the latest on that reporting for Elon Musk's vision of Twitter potentially becoming a public company yet again. That's next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Let's get back to Elon Musk's evolving vision for Twitter, taking the company private, but not blocking out the possibility of becoming public again in the future. Our Ed Ludlow here to discuss. We're getting some new information in a report from Dow Jones. What do we know?
So Dow Jones is reporting, according to their sources, that Elon Musk is telling potential co-investors, because remember, he's still trying to line up the equity portion of this deal, that he could eventually take Twitter public again. And he could, according to Dow Jones sources, do that within a 3-year time frame, which is interesting because he's trying to take Twitter private.
So, talk to us more about what he has said.
Yes.
What clues we have about, his, how he plans to evolve Twitter and how it would then ultimately make sense for it to be a public company again eventually.
I mean, in the letter to Twitter's board when he first made the offer for the company, he said, these changes which I want to enact can only be done if Twitter is private. And those changes range from removing bots, open sourcing the algorithm, having a time-limited edit button he's talked about. He's talked in tweets. He was at the Met Gala last night saying Twitter can be the most inclusive, best platform out there. It just needs to stick to the principle of free speech. But he's also trying to line up co-financing, right? And a big question for investors that get involved is, how do we make money on this in the long run?
What's the timeline for him to line up that final batch of equity?
Well, so remember, the deal hasn't actually closed. So $54.20 a share for each shareholder that has a share and as many shares as they have by year end. And the expectation is that existing Twitter shareholders will vote for this. They'll go for it. but who knows?
Well, I'm sure there'll be more dribbles of news
Right, twists
all
and
the way
turns.
to the bitter end
Right.
at Ludlow. Thank you. Meantime, the world of one-click checkout startups has been a race to number one. But recently, there have been a lot of questions about viability. Most recently, Bolt Financial was sued by its most prominent customer, which includes the parent company of Forever 21, alleging that Bolt overstated its customers and failed to deliver on promised technology, leading to a $150 million loss in online sales. I want to talk about this all with Albert Saniker. He is the founder and CEO of Nate, a universal shopping app with a one-click checkout function. Albert, thank you for joining us. So first I want to clarify, you are in the same sort of general business, but do something different to what Bolt promises to do. Can you explain your one-click checkout technology?
Yes, thank you, Emily. I'm excited to be here. So yes, Nate is the world's first universal shopping app. You can download it, enter your shipping and payment information once, and you can skip the checkout anywhere, pay now or pay later, and share shopping lists with your friends. So Nate is a consumer business. We don't sell software to retailers.
So what's your take on the controversy surrounding Bolt, which in turn has shined a spotlight on the space? I mean, there are some people who think that Bolt is hiding shoddy business fundamentals, and that maybe is, grossly overvalued.
Well, look, I can't speak about the specifics of Bolt. I know that every company is different and every management team is different. I'll tell you that, broadly speaking, when you're building a payments business, you have a choice to make. And the choice is, who is your customer? Is your customer the retailer, or is your customer the consumer? Much like in real estate, right? Do you represent the seller or do you represent the buyer? And there are lots of really interesting software companies that are selling software to retailers. And sometimes they sell them software for conversion upside in the form of one-click checkout, or in the form of point of sale financing, or in the form of shipping insurance. And those are great businesses, but that is not what Nate does. Nate is a consumer business.
I want to talk to you a little bit more about Ryan Breslow, the founder of Bolt specifically, though, because he has been incredibly vocal and opinionated, for better or for worse. It seems like he was ousted from the CEO spot. He's staying on as chair. Do you think that founders should be that outspoken?
I know how hard it is to build a business from scratch. I can tell you that firsthand. And different founders have different approaches to product development, go-to-market, and team building. And I have the utmost respect for those who are, more or less vocal about how they're building those things. My style is more focused on observing this new generation of shoppers and building for consumers and letting the rest of the other pieces fall into place.
Then you have another company in this space called Fast, which recently shut its doors. So, there's this question about, is this kind of technology really possible? Is it overhyped?
I actually argue that one-click checkout is a great feature, but it is a feature nonetheless. And the question is, if your customers are retailers, then what are the other services that they need in order to sort of build a compelling product? In the case of Nate, our customers are consumers. And I can tell you for sure, without a doubt, that consumers want one-click checkout. There's no doubt about that. But they want a few more things than one-click checkout. They want aggregation. The sort of aggregation that happened in music with Spotify, it happened in food with DoorDash, it happened in transportation with Uber. And it's happening now in e-commerce with Nate. Consumers demand aggregation of these 2 million retailers in the non-Amazon economy.
You've got Bolt and Fast. Why is your company called Nate?
So Nate is, in a way, an assistant that lives in the cloud that does things on your behalf. So we knew that we wanted to personify it. And I also wanted to make sure that we didn't use a woman's name, because there are lots of assistants out there that have associations with the word woman, and the warmth competence trap is real. So if we are going to objectify a machine that does the heavy lifting for us, we might as well have a man's name. Although we use it pronouns, Nate has no gender. And it was actually a play on the words native commerce that is native.
All right, well, it sounds like a very interesting play. We will continue to follow. Albert Saniger, founder and CEO of Nate. Thank you. Coming up, Coinbase CEO Brian Armstrong spoke at the Milken Global Conference about everything from crypto adoption to a decentralized Twitter. We'll talk about all this and more with the Web3 company The Graph. Up next, this is Bloomberg.
I think freedom in all forms is worth defending, and crypto is a lot of it is about economic freedom, so freedom of speech is another version. I do think there's an opportunity for Twitter to essentially embrace using a decentralized protocol. And just in the way that you've probably heard of DeFi, which is decentralized finance, there's another one called DSO, decentralized social media, which is another emerging area coming up. If you look at how crypto has grown over the last year or two, it's growing faster than the internet did in the early days. And there's now about 200 million people in the world who have crypto or have tried it. And so if you just plot that curve out, it means that within this decade, we're going to have over 1 billion people in the world using crypto. And to me, that's just incredibly exciting.
Coinbase CEO Brian Armstrong there at the Milken Global Conference. I want to dive into all of this and more in our crypto report with Ava Bailin, director of the Graph Foundation, which has a mission to allow for full-stack decentralized applications, or dApps, with an indexing protocol for querying blockchains. Eva, thank you so much for joining us. So what do you think? 1 billion people using crypto in a decade? Will it happen?
I think it'll totally happen. And, really the question is, where are these individuals coming from and what are they going to do? And I think we often think about crypto in this speculative nature, DeFi is the center of attention, but really what crypto and Web3 enables is access to banking, access to content. So, even echoing Brian Armstrong, things like DSO or decentralized Twitter are definitely in the works. But even at the Graph, we like to think about this as the next step in iterating the gig economy. So, people like to stake their tokens, on Web3, and it's very similar to holding an asset and expecting it to be useful, in fiat or Web2 world. But here you actually get to work for a protocol. So we're really excited to see what this looks like, where people actually start working for the technologies, putting their capital to work, and actually getting to earn a portion of that revenue.
Meantime, there's still a sort of Wild West feel about the crypto landscape. Coinbase is also now cracking down on the issue of people front-running tokens based on whether Coinbase might be about to list them. What's your take on that?
I think just like in typical startup world, you're going to have 9 out of 10 startups that don't succeed. And similarly in crypto, the value of the token or the productivity of the token in a protocol, or the success of a community is still going to be reflective of its quality. So I think that we need to start focusing a little bit more on which tokens and which protocols are sustainable, which are going to actually provide real value in the next decade or, 2 decades, 3 decades, and which are the communities that are going to sustain themselves. One major difference between Web3 and Web2 is the switching costs are much lower. It's really, really inexpensive for a user to start using a different dApp or a different protocol, whether it's just transferring tokens to another wallet, or really just completely up and moving. And so I think these product teams, these communities have a lot more pressure to deliver high quality experiences.
Meantime, the SEC is adding 20 more people to its team policing crypto markets. I'm curious, does that signal more regulation, more enforcement coming?
We've always been fairly open that regulation is welcome. It's not that the crypto industry wants to be unregulated. We just want more clarity. So, in general, this bodes well for having more resources focused on our industry. And, our goal really is to have more folks that are, applying the law and applying their policies in a way that's conducive with innovation and not stifling growth, as is possible in this new wild west of development.
The industry is still scaling, still working on interoperability, and there's a lot of work to do. What's your role in that at the Graph?
Yeah, so we as the Graph, as you mentioned, we're an indexing protocol, and really all that means is we're trying to make it easy to organize data, making it easier for developers to access that data. People will often call us the Google of blockchains. And so we're really here to unite all developers, full stack, backend, and make it easier for anyone to build across applications, across chains, and acting as a uniting layer where any API, any way that you can access data should be open source, and anyone should be able to do that and build on top of any protocol.
So I'm curious about your thoughts on open source and how far that goes. What do you think about open sourcing Twitter's algorithm?
I think that's a great idea. I'm all for the decentralized movement, especially with something as useful as Twitter. My general stance with open source, versus closed source is I think there's a lot of FUD around open source ruining business models. At the end of the day, sustainability is really what matters when it comes to a good business or a product. And if you can continue building, to actually continue building on a protocol, whether it's open source or closed source, is a challenge. And so the protocols and dApps that are more likely to succeed are the ones that actually innovate on top of existing models rather than just replicating and copying them and moving on.
And how do you see the Ethereum merge impacting the broader landscape? Just how sort of tectonic do you think that will be?
I think there's a few narratives here. So, on one hand, this is the first major blockchain that's moving to proof of stake. I think there will be ripple effects and how does this impact other chains? But more broadly, I think it's the first step for, non-technical people, non-developers to see what it really means to have your assets put to work, to have a utility token like Ethereum, Ether, and being able to actually earn revenue and generate income as an individual from participating in that blockchain. It's a completely novel concept. Even the gig economy is fairly new, but Web3 enables this possibility that individuals can have full sovereignty over their assets and the way they contribute to technology.
All right, Eva Bailyn, director of The Graph. Thanks for joining us to share your view of the crypto DeFi future. Coming up, solving climate change with deep tech. We're going to speak with DCVC co-founder and managing partner Zach Bogue about how they're helping tackle society's biggest challenges and also hoping to make some money doing it. That's next. This is Bloomberg. Time for this week's Techonomics segment, and we are speaking with Zach Bogue, co-founder and managing partner of DCVC, which has a mission to back entrepreneurs solving trillion-dollar problems to multiply the benefits of capitalism for everyone, but all the while reduce costs. Problems like climate change, Zach. But what exactly does that mean? Tell me about your mission.
Sure. So to put it more concisely, we like to back entrepreneurs solving trillion-dollar problems computationally. These are hard problems in the climate. These are hard problems in life sciences, hard problems in transforming industry.
Now, historically, we've seen big venture capital firms like Kleiner Perkins, for example, dive into clean tech investing and then pull back because the returns just weren't there, at least not in a reasonable time horizon.
Absolutely.
So why do you think you can make it work now?
Over the past handful of years, there's been massive advances in computational approaches, AI, machine learning, machine vision, that have massively reduced the capital required to solve some of these problems. Not all. Some of these problems are still great for government, but there's companies like my company Pivot Bio that is replacing synthetic fertilizer, 9% of global greenhouse gas emissions, replacing that with microbes. So there's real possibility to make big changes in this sector.
So let's talk about some of the contributions we've seen in this sector. We've seen Alphabet, just in the last month, Alphabet, Elon Musk, and many more commit more than $2 billion to startups tackling climate change. Talk to us about where you see the capital flowing and what's most significant about it.
So those declarations are great, and we need much more of those type of things. We see money flowing into areas like methane remediation, which is one of the lowest hanging fruit, industrial transformation, electrifying the grid, electrifying everything, just basic deep tech areas.
The lowest hanging fruit, why do you think that is?
So methane is a relatively ephemeral gas, and it's the largest source of greenhouse gas emissions for the planet, and it only is short-lived in the atmosphere. And our company, Kairos Aerospace, helps detect methane leaks, and they've already had a bigger impact than Tesla. Many people are surprised to hear that, but Tesla's...
So let's say that again.
Yeah.
Which company has a bigger impact than Tesla?
Kairos Aerospace. Tesla's 2020 impact report, 5 million tons of CO2e prevented. Kairos in 2020 was 7 million. It's only increased there for Kairos.
How do they do that?
They have sensors, and they do basin-wide surveys of installed oil and gas infrastructure, which is very leaky. Leaks methane, and they help pinpoint the leaks and help the companies rapidly fix them.
So the challenges ahead are, of course, tremendous, but there's also a lot of macroeconomic uncertainty, inflation, consumers under pressure, businesses under pressure. I mean, look what's happening in the public markets. Does that concern you in terms of, some, funds that have been pouring money into these spaces potentially pulling back?
Absolutely. So the public markets are in a risk-off scenario right now. We all know that, and obviously there's a lot of bad stuff going on out there. Things have slowed down. We've seen deals repricing for follow-on deals of our existing deals. We've also seen a lot more structure coming into deals. So this has affected the whole market, and we're sort of taking a wait-and-see approach. We're still doing good deals. Good deals are still getting done, but I think everyone is taking a little bit of a breather, and the pace of capital deployment is slowing down.
Now, you invest in deep tech, which takes time to scale and to deliver these computational approaches, as you're talking about. How do you ensure that companies hit their milestones and still make a profit?
Absolutely. These are problems that are capital intensive a bit more. We've just heard that the capital requirements are less if you can rely on computation. Obviously, you need great execution from the team to hit their milestones, but they are solving trillion-dollar problems. So once they do solve them, they create giant, durable, capitalist, successful companies that produce huge returns for investors.
How big are the returns? Let's talk about that. What's a huge return in your view?
Huge return is, creating the next trillion-dollar company, right? And these, the types of companies that you can create with deep tech are, fixing, the fertilizer industry. We heard Pivot Bio. That's a $212 billion industry, 95 million acres of corn in the U.S. that can be transformed to this much less polluting industry. So if you can solve that, you can create enormous, durable businesses.
So are you saying let's say in a decade, could the trillion-dollar companies in a decade be the next Apple and Google and Amazon and Facebook? Could they be companies focused on tackling climate change?
They will be. And Larry Fink of BlackRock obviously said that the next $50 trillion, of 50 unicorns will be these companies.
So what's gonna make or break whether or not that happens? Obviously, the problem is real, but investors want returns, and the question is, will those returns happen fast enough?
These companies are more capital intensive, but there is going to be insatiable demand for high-quality public equities that are addressing the climate. So our pathway is we're going to back these companies at the early stages and ultimately get them public, and there will be huge demand for these stocks, not to mention they will be profitable because they're solving these trillion-dollar problems.
Is the government giving these companies, these industries enough support?
The government could always be doing a lot more. We don't back regulatory change or prospective regulatory change. That's great. I want there to be regulatory change, but that's not something that we view as venture backable. We need to back companies that have a working business model with a real product that customers are willing to pay money for. So this is very much a capitalistic endeavor. We are not a double bottom line fund.
What more could the government do?
The government could put in a carbon tax, for instance, which has been very pernicious. They could also encourage more investment, right? Obviously, some of the best technological breakthroughs have underpinnings of government research. So those are two huge areas that the government could have a big impact.
All right.
Locally, the government in California could keep Diablo Canyon, our last functioning nuclear power plant, open, which would have a huge impact for the climate.
Interesting. All right. Well, we'll be watching to see which is the first of those, companies to become the next trillion-dollar company. Zach Bogue, co-founder and managing partner of DCBC. Thank you for joining us. Good to have you back on the show. And that does it for this edition of Bloomberg Technology. Tomorrow, Airbnb CEO Brian Chesky will be here to talk about the company's earnings results and the biggest change to Airbnb, he says, coming in a decade. And also, don't forget to check out our podcast. You can find it anywhere you get your podcasts. I'm Emily Chang in San Francisco. This is Bloomberg.